oil flirting with triple digits, an AI investment boom powering earnings, and equity indices still hovering near their highs. That tension is defining the risk backdrop right now. Welcome to vTalkInsight, Equity Pulse Daily for May 5th, 2026. Let us unpack how the energy shock, AI leadership, and rising geopolitical frictions are reshaping the equity landscape from the top down and the bottom up. Equity indices remain relatively resilient, but the macro backdrop is increasingly dominated by an energy shock that looks more stagflationary by the week. Oil prices are holding near levels that act like a tax on both consumers and corporates, while volatility in the Middle East and the Strait of Hormuz keeps the risk premium alive, even if day-to-day price moves look muted. Brent crude has pushed above $109 a barrel, with New York benchmarks over 103, as shipping risks and supply losses accumulate around the Gulf. At these levels, estimates suggest that if oil averages $100 through the second quarter, it could shave around 0.4 percentage points off United States growth, underscoring how sustained price pressure can erode the macro cushion beneath equities. We are already seeing real economy adjustments. Global airlines have cut roughly 2 million seats in recent weeks, and carriers, especially in the Gulf, are reshuffling networks to cope with costly and uncertain fuel supply. United States airlines, which are largely unhedged on jet fuel, face direct margin compression and are responding with higher fares and route cuts. Europe, with far less energy self-sufficiency, remains more exposed than the United States to any prolonged disruption or a move toward $120 Brent through the summer. On the household side, spending still looks resilient, helped recently by larger tax refunds, but the underlying income picture is softer. Real disposable income is growing at only around 0.4% year-on-year. That gap is being bridged by drawing down savings and leaning more on credit, which raises questions about how long consumption can prop up earnings if energy remains expensive and confidence starts to fade. Policymakers are alert to the fragility. Federal Reserve Governor Barr has warned that stress in private credit could trigger psychological contagion and a broader credit crunch, even without obvious direct linkages. Yet credit spreads remain historically tight, and the United States Treasury is still leaning heavily on short-term bills, increasing rollover risk just as bond markets are nervous about deficits, inflation, and refunding plans later this week. For central banks, the energy shock complicates everything. Core measures such as personal consumption expenditures inflation remain above 3%, and officials have stressed that a prolonged Middle East conflict could push energy and even fertilizer prices higher, delaying any hope of rate cuts. Some in the market still see room for easing this year, but that is now heavily conditional on a swift cooling of oil and a calmer Gulf. The key signals to watch are the trajectory of crude, any concrete progress on Iran's ceasefire proposals, Treasury issuance decisions on Wednesday, and United States payrolls on Friday, all of which can shift how much macro drag equities have to discount. Against that macro headwind, the single biggest support for equities remains the artificial intelligence boom. Recent data suggests that AI-related investment alone has contributed around 1.5 percentage points to roughly 2% United States growth. That means the expansion is leaning heavily on three narrow pillars: affluent consumers, AI-driven capex, and rising asset prices. If any of those wobble, the macro story can change quickly. Corporate results reflect the same pattern. Earnings are robust overall, but growth is extremely concentrated. The so-called Magnificent Seven technology names account for close to 60% of first-quarter earnings growth for the S&P 500, and gains in the index are similarly dominated by mega-cap tech. Beneath the surface, the average stock is still well below its high, and consumer discretionary names have lagged, which is consistent with a market that is relying on a narrow set of AI beneficiaries to offset broader economic fragility. The AI trade is global. Asian equity markets have rallied hard on renewed optimism, with indices like Korea's Kospi and Taiwan advancing more than 4% as hardware suppliers link into hyperscale spending. Names such as TSMC, Korean memory makers, and Samsung, which has just reported a roughly 45-fold surge in profits, are seeing strong demand. European chipmakers including ASML, ASM, and Infineon have outperformed year-to-date, while STMicro and SAP are leading European tech gains, helped by this global supply chain momentum. There are, however, cracks to monitor. Rising AI-related capital expenditure is increasingly financed by debt, and companies like Amazon are showing cash flow strain even as they push to stay ahead in cloud and infrastructure. Hedge funds have been significant net sellers of United States tech over the past 2 weeks, marking the second largest de-risking in the sector in a decade, while systematic trend followers have turned into net sellers of global equities as well. Offsetting that, retail investors and corporate buybacks are still providing support, and there is notable cash on the sidelines with many households underinvested in equities. Some allocation data point to overweight positions in equities, particularly in Europe and emerging markets, and underweights in bonds. At the same time, investors looking for hedges increasingly favor liquid alternatives such as catastrophe bonds, gold, and broad commodities over traditional government debt, reflecting skepticism that bonds will diversify effectively in an AI plus stagflation regime. The upshot is that as long as AI earnings continue to surprise on the upside and hardware suppliers deliver, the index level can remain supported even with poor macro news. But if the AI narrative weakens, markets could see a sharper correction than last year because fundamentals outside tech have softened and dip buying may not be as automatic. Upcoming semiconductor earnings, guidance from cloud and e-commerce platforms on AI capex, and any broadening of earnings growth beyond megacap tech will be crucial signals for how sustainable this leadership really is. These crosscurrents are playing out very differently across regions. United States equities are outperforming, helped by AI and technology strength plus relative energy independence, which cushions the blow from higher oil. Asian markets are also riding the AI wave, with strong United States tech earnings setting a positive tone for chipmakers and hardware names across Korea and Taiwan. In contrast, European equities are underperforming, reflecting a combination of higher energy dependency, weaker growth, and mounting tariff threats. Europe now faces a classic stagflation dilemma. Growth forecasts are being revised lower even as inflation expectations tick up, driven by the energy shock and geopolitical uncertainty around both Iran and Russia. Markets are pricing in a more hawkish path for the European Central Bank and the Bank of England, despite soft data, while policymakers try to cushion households through targeted and temporary fiscal measures and simultaneously ramp up defense spending and technology investment. Trade policy is adding another headwind. The United States administration has threatened to increase tariffs on European auto imports from around 15% to 25%, with scenarios suggesting that could cut European carmakers' operating earnings by 12 to 20%. Stocks such as Volkswagen, BMW, Mercedes, Porsche, and Volvo are already under pressure on the threat alone, illustrating how sensitive the sector is to even the possibility of a renewed transatlantic trade war. In Asia, the picture is split. Hardware and semiconductor exporters are clear beneficiaries of the AI cycle, but China is contending with energy supply restrictions linked to the Iran conflict and with rising tensions over sanctions enforcement, after Beijing instructed refiners to ignore certain United States measures. Looking ahead, a structurally weaker United States dollar is expected by some as Washington tolerates higher inflation to manage debt, which could favor emerging markets, particularly commodity exporters and countries whose central banks are leaning toward easing. How that plays against elevated geopolitical risk and trade frictions will set the tone for regional rotations in the coming months. At the micro level, several industries are already showing how the macro themes feed through to equity risk. Airlines are a clear example. Global carriers have removed about 2 million seats from schedules over the past couple of weeks as jet fuel prices surge and concerns about availability grow. United States airlines, which mostly do not hedge fuel, are directly exposed. Stronger operators can pass on costs through fares, but ultra-low-cost models are strained. The collapse of Spirit Airlines underscores that vulnerability. Thin margins and limited pricing power left little buffer once fuel costs jumped, and other carriers are now absorbing stranded passengers and reconsidering unprofitable routes. Officials currently see no need for broad bailouts, but acknowledge conditions can deteriorate quickly if the shock persists. In Europe, much of the consolidation has already happened, leaving fewer obvious merger candidates and concentrating risk in a smaller number of large groups. Elsewhere, flows are highlighting demand for real assets that can ride out inflation and volatility. Investors are favoring diversified vehicles such as Brookfield Infrastructure Partners and copper producer Freeport-McMoRan as potential beneficiaries of higher nominal growth and energy-linked investment. Berkshire Hathaway offers another lens. It is sitting on a record cash pile and has resumed buybacks, signaling caution on prevailing equity valuations even as it returns capital. Its insurance operations, including Geico and reinsurance, now generate roughly 30% of earnings and underpin a substantial investment float. Within that, Geico is shifting strategy to prioritize growth over near-term profitability, accepting lower margins to gain share in auto insurance. That move hints at intensifying competition and a willingness to lean into volume even in an uncertain macro environment. On the other end of the spectrum, GameStop has proposed a $56 billion cash and stock acquisition of eBay at about a 20% premium to eBay's prior close. The deal would require roughly $20 billion of new debt and aims to create a more credible rival to Amazon. Market reaction has been skeptical. eBay's share price has jumped but still trades below the offer, reflecting doubts about financing and execution. The fact that Amazon's annual capital expenditure exceeds the combined market capitalizations of both GameStop and eBay highlights the scale required to compete in this space. At the same time, strong transaction volumes at Visa, MasterCard, and American Express confirm resilient consumer activity, even as credit risks build in private markets. With credit spreads still tight and some investors deliberately holding back capital for a correction, developments in private credit, large leveraged deals, and real asset flows will be key indicators of how much hidden stress is accumulating beneath headline equity strength. Putting it all together, equities sit at the intersection of an oil-driven stagflation risk and an AI-driven earnings boom. Index levels still look robust, volatility remains contained, and a narrow group of technology and semiconductor leaders is doing most of the heavy lifting. At the same time, elevated energy prices, fragile consumer finances, tight but potentially unstable credit conditions, and rising trade and geopolitical frictions are all building a macro overhang that markets may not be fully pricing. Airlines, autos, and other energy-intensive or trade-exposed sectors are already feeling the strain, while real assets and high-quality cash flow stories continue to attract interest. From here, the key signals to watch are the path of oil and Gulf tensions, upcoming United States payrolls and Treasury refunding decisions, the next leg of AI and semiconductor earnings, and any concrete moves on European auto tariffs or private credit stress. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.